Right. Amalgamation, when we see the introduction of amalgamation, amalgamation is when a company, in order to expand or become more profitable, decides to merge or may absorb other organization or another company. That means one company is there which is already existing in the market, and the other company is also existing in the market. And they both companies decide to amalgamate, either to merge, or one company is taking over the another company. The formation of merge or formation of absorption of other company, we call it as amalgamation. Amalgamation, two or more than two companies are combined into one by merger, or by one taking over or the other company. Hence, the term amalgamation means of two categories or two activities. Two or more companies can join together, or one company can take over the another company. We call it as amalgamation, which also includes an absorption. In amalgamation, there is a sale and a purchase. Sale and a purchase takes place. That is, here one company is purchasing other company. So here purchase and sale both takes place. One company is selling its organization and the other company is purchasing its operation. Hence, the books of the selling company must be closed and the books of the purchase company must be open, because the company which is selling its operations, which is selling its organization, it will close its entire business. So for a selling company, there won't be any books of accounts because it is closing its organization. Whereas the company which is purchasing the selling company, they have to open books of accounts because they are purchasing company and that company is still existing in the market. Now here we have purchaser and seller. The one who is purchasing a company is purchasing company, and the one who is selling its company is a selling company. Selling company, we call it as transferor company because he is transferring entire assets and liabilities to the purchasing company. And the one who is purchasing, that is the purchasing company, we call it as transferee because they are getting all the selling company's assets and liabilities. So they are the transferee company. Remember, selling company is the transferor company and purchasing company is the transferee company. Now, when we see the types of amalgamation, as per the accounting standard AS 14, there are two types of amalgamation. One is amalgamation in the nature of merger and the other one is amalgamation in the nature of purchase. Now, there is a difference between the merger and the purchase here. Both are amalgamation only, but in case of merger, the existing company will merge its entire business to another existing company by the way of merger. Say, for example, we have company A and company B. Both are running successfully in the market, but they decided to merge together. They decided to combine their operations together. Hence, A company, B company will merge, will combine, and they will start a new company called AB company. So this process, we call it as merger. That means two existing company come together and start a new business is merger. Whereas amalgamation in the nature of purchase, here one company will purchase the another company like A and B. A is purchasing B company. Because B is selling its operations, B won't be there in the market. A only will be there in the market. A will be existing in the market. Hence, it is called purchase type of amalgamation. So, both are different. Merger, two existing companies created into a new company. Whereas in the nature of merger, one existing company will take over the another existing company, whereby the selling company will no more be existing in the market and only purchasing company will be there in the market. So these are the two types of amalgamations. Now, amalgamation in the nature of merger, individually when we see it, an amalgamation in the nature of merger should be considered when all the 5 conditions are satisfied. When we can say it is in the nature of merger, we have got certain conditions to satisfy that it is an amalgamation in the nature of merger. And the first condition is all the assets and liabilities of the selling company becomes after amalgamation the assets and liabilities of the transferee company. Say, for example, selling company is A company, purchasing company is B company. Now, when selling company is selling its assets, all assets must be transferred to B company. That is the first category, first point, first condition, that assets and liabilities of selling company must be transferred to the purchasing company. Then second one is, no adjustment is intended to be made in the books of value of assets and liabilities of the selling company when they are incorporated in the books of purchasing company. Once the selling company sells its entire assets and liabilities to the purchasing company, there won't be any A company existing in the market. That is, the selling company will not be there in the market. Hence, no books will be maintained by the selling company. Only the books will be incorporated by the selling company in the books of the purchasing company. Then, shareholders holding 90% of the face value of the equity shares of the selling company become the equity shareholders of the purchasing company. Because purchasing company is purchasing the entire selling company's assets and liabilities, so 90% of the face value of the equity shares should be owned by the purchasing company. Then only we can say that it has purchased, it has acquired the selling company. So selling company should have 10%, whereas purchasing company should have total 90% of shareholding over the selling company. Then the purchase consideration. In the previous class, we have discussed this purchase consideration. The word consideration, we mean something in return. When a company is purchasing another company, the purchasing company should give something in return to the selling company. That amount, we call it as purchase consideration. Who will give purchase consideration? Purchasing company will give the purchase consideration. Who will take the purchase consideration? Selling company will take the purchase consideration. So purchase consideration for the amalgamation is discharged by the purchasing company either wholly or by the issue of equity shares. Either amount will be issued by the way of purchase consideration, or wholly the equity shares will be issued by the purchase consideration. It depends upon the purchasing company, whether they want to give the cash or they want to give the equity shares. Then the business of the transferor company is intended to be carried on after the amalgamation by the transferee company. Because selling company is selling its entire operations to the purchasing company, there won't be any selling company in the market. So in the market, only purchasing company will be existing. Hence, the entire business of the selling company also will be taken over and will be undertaken by the purchasing company only, that is transferee company. Then amalgamation in the nature of purchase. In the previous 5 points we have seen, that is related to the amalgamation in the nature of merger. Now this is in the nature of purchase. If any one or more of the above conditions are not satisfied in amalgamation, such an amalgamation is called amalgamation in the nature of merger. Now for merger, 5 conditions need to be satisfied. If any of the condition is not satisfied, that will be converted into another type of amalgamation, that is amalgamation in the nature of purchase. Now when it comes to accounting methods, types of amalgamation is the way they are going to amalgamate their companies, that is in either by the way of merger or by the way of purchase. Whereas methods of accounting is how we are going to show that merger or purchase in our books of accounts. Now in the books of accounts, the amalgamation can be reported by the way of methods called pooling of interest method, which is nothing but your merger, and another method we have is purchase method. 2 types of amalgamation, amalgamation in the nature of merger, amalgamation in the nature of purchase. 2 types of accounting for amalgamation, pooling of interest method, which we also call it as merger, or the purchase method. Now, pooling of interest method. Under this method, the assets, liabilities, and reserves of the selling company will be taken over by the purchasing company at their existing value. Because selling company is selling its assets and liabilities, so all the assets, liabilities, and reserves must be transferred by the selling company to the purchase company at the values at the time of the selling company is selling its assets. Whereas in purchase method, the assets and liabilities of the selling company are taken over at their revalued figures in the books of purchasing company. Hence, the reserves of the selling company should not be taken in the books of purchasing company. The difference between pooling of interest method and the purchase method is, in pooling of interest method, including reserves, assets and liabilities will be transferred by selling company to the purchasing company. Whereas in case of purchase method, Assets and liabilities will be transferred at the market value, whereas reserves cannot be transferred. Reserves will be left over as it is with the selling company. That is the two differences which we can see between the pooling of interest method and purchase method. Reserves along with assets and liabilities transferred by selling to the purchasing company in merger. Whereas in purchase, only assets and liabilities will be transferred. Reserves are not transferred by the selling to the purchasing company. Reserves will be there with the selling company itself. So that is the difference which we can see between the amalgamation in the nature of merger and amalgamation in the nature of purchase, pooling of interest method and purchase method. Now, when it comes to accounting perspective, that is a problematic point of view. Steps in accounting. First, we need to calculate the purchase consideration. If purchase consideration is given in the problem directly, no need of calculating it. Otherwise, first we have to calculate the purchase consideration. Then we need to enter the journal entries in the books of both the parties, selling party and the purchasing party, that is transferor as well as transferee party. And finally, we need to prepare the balance sheet by preparing some of the subsidiary books. These are the three steps you must be very careful when you are preparing accounts with regarding to the amalgamation. First one is calculation of purchase consideration. Second one is journal entries in the books of transferor as well as transferee. And the third one is balance sheet must be prepared for the purchasing company. At the end of the problem, balance sheet we will prepare only for purchasing company, but not for the selling company, because selling company will not be existed in the market when we prepare the balance sheet. Now, purchase consideration. Purchase consideration means the price payable by the purchasing company to the shareholders of the selling for the business taken over by the purchasing company. As I told you, we will have purchasing company who will purchase, the selling company who will sell its business. So when selling company is selling its business, purchasing company should give something in return. That price is called as purchase consideration. Now, in order to calculate the purchase consideration, we have four methods. First one is lump sum method. Lump sum method, the total amount will be decided by the purchasing company, that they are going to give some 10 crores or 20 crores like that, without no need of calculating anything over it, because directly the amount is mentioned. That comes under your lump sum method. Second one is your net assets method. In net assets method, we take all the assets. From the assets, we deduct the liabilities which are meant for the outsiders. Then the balance is nothing but your purchase consideration. Then third one is your net payments method. Net payments method, we first consider the liabilities. From the liabilities, we deduct the assets. Leftover is called as purchase consideration. And the last one is share exchange method or intrinsic value method. In the first three methods, we consider either assets and liabilities, whereas in the last method, fourth method, they don't go for taking up the assets and deducting the liabilities. In the fourth method, they will exchange the shares between two companies. So that is share exchange method, or we call it as intrinsic value. Intrinsic value, we say it because the face value of the shares we will consider, hence we call it as intrinsic value method. But above all the four methods, net assets method is most important and share exchange method is most important. We follow mostly net assets method. And another important thing is when you're calculating purchase consideration, if we have only assets and liabilities information given in the problem, we go with the net assets method. If assets and liabilities information is not given, and if shares related information is given, we go with the share exchange method. This is how we go with net assets method or share exchange method, depending upon the information that is provided to you in the question. Right. Net assets method, we take all the assets excluding fictitious assets, less liabilities taken over at the agreed value, excluding shareholder funds. Excluding shareholder funds, here we mean equity shares, preference shares. Remaining all shares, we will take it in the net assets method. Remaining all liabilities, we will take it in the net assets method. Now, when we are calculating purchase consideration using net assets method, we have to be very careful with regarding to which assets we are taking and which liabilities we are taking. Assets include cash, bank, goodwill, and prepaid expenses. Assets will never include miscellaneous expenditure. Any asset not taken over do not include while calculating purchase consideration, and all assets of selling company should be taken at revalued figures. Market values we have to take, cash balance, bank balance, goodwill, and prepaid expenses we have to take. We should not take miscellaneous expenditure, which will occur once in a while. And we should not take any asset which is do not included while calculating the purchase consideration. So these must 4 points you have to remember when you're calculating the purchase consideration. Then the liabilities, we take liabilities only which is the liabilities which have to be taken only for meant for the outsiders of the organization, but not the insiders of the organization. Like share capital, reserves, and accumulated profits, you should never include in the liabilities concept when you are calculating purchase consideration. And any reserve, any redemption, any premium, any dividend equalization fund, all these things should not be included in the liabilities when you are calculating purchase consideration using net assets method. And share exchange method, ratio. On the basis of the ratio, the shares will be exchanged between this purchasing company to the selling company. It is something like purchasing company will give 5 shares, and purchasing company will take 2 shares from the selling company. So it is 2:5 ratio. That means for every 2 shares, selling company is receiving 5 shares from the purchasing company. That means selling company is giving 2 shares. In return, purchasing company has to give 5 shares to the selling company. So this is how the ratio will be between the selling and purchasing company, that is 2:5 point of view. Then we will enter the journal entries in the books of both the parties. This is about the introduction of amalgamation, the theory part. Now let us see a problem based on amalgamation. Right, this is a problem which is based on the amalgamation. The A Limited and B Limited, whose business are similar in nature, decided to amalgamate, and the new company C Limited is formed. Now, this is called amalgamation in the nature of merger because A Limited is already existing in the market, B Limited is already existing in the market. They both decided to close their operations and they decided to start a new company that we call it as C company. So, it is a combination of amalgamation in the nature of merger. Take over the respective assets and liabilities. The following is their respective balance sheet. Remember, in this case, we have 3 companies. The first 2 companies are the existing companies, and the third company is the new company. For this new company, you need to prepare the balance sheet. For existing companies, old companies, already balance sheet will be given to you in the question. Like you can see the balance sheet, A Limited, B Limited figures are given in the same balance sheet figures. Assuming that the assets realized at their book values, what amount each company will get? Amount each company will get in the sense purchase consideration. So they are asking us to calculate the purchase consideration. Because we have assets and liabilities information given in the problem, we apply net assets method to calculate the purchase consideration. And also they are asking us to prepare the balance sheet after the necessary journal entries which are entered in both the companies. So in this problem, first, we need to calculate the purchase consideration of 2 companies. Then journal entries we need to enter in the books of A Limited, in the books of B Limited, as well as in the books of C Limited. And finally, we need to prepare the balance sheet. Now, if you see here, calculation of purchase consideration, as the amount paid by C Limited is not mentioned because purchase consideration amount is not mentioned. Hence, we have to calculate the purchase consideration. We apply net assets method. Why we are applying net assets method? Because we know the only assets and liabilities information of A and B Limited. Hence, the only method that is left over for us is net assets method. Now, as per the net assets method, we take the assets first, all assets taken over by the C Limited. Now, first, if you see the assets point of view, we take goodwill, freehold property, plant and machinery, stock, debtors, and cash at bank. There is no miscellaneous expenditure in this. So hence we are taking all the assets at the same book values because market values are not mentioned to us. So we take all the book values. So the total amount will be 83,300 and 52,000 for A limited and B limited. From that, we need to deduct the liabilities, outside liabilities. That is the liable parties who are outsiders to the organization. Share capital belongs to the insider parties. Hence, this cannot be taken for the calculation of the purchase consideration. Then we have to take bills payable because it is payable to outsiders. Then creditors we have to take. So we can take the creditors. Here, if you can see creditors, bills payable we have taken. Reserve and profit and loss account belongs to the insider parties. It belongs to the existing companies only. So we cannot take it. Hence, we take only creditors and bills payable. Now, after you deduct the creditors amount and bills payable amount from the concerned columns, the balance of amount we call it as purchase consideration. All assets minus liabilities to outsiders is your purchase consideration as per the net assets method. Now, for A limited, the purchase consideration is 80,000, and for the B limited, the purchase consideration is 50,000. So this is how we calculate the purchase consideration with regarding to uh, net assets method. Using the net assets method, we calculate the purchase consideration. Now we need to enter the journal entries. We have two transferors here because A limited, B limited, both are closing its operations. So both are selling companies here. So we have two selling companies. So two transferors and one new company, transferee company, purchasing company, C limited. Now if you can see here, A limited, that is transferor company journal entries. Now, when we are entering journal entries in the books of transferor company, we need to create a new account called realization account. The word realization here, we mean it is very clear. Realization, we mean what we have realized out of sale of assets. After selling the assets, what is the amount we received? That is nothing but your realized amount. So hence, to understand, to know what is the amount realized by the transferor company, we need to create a realization account. So the journal entry will be realization account data to all assets. All assets, the assets which you have taken at the time of purchase consideration. So same assets we take it here. So same assets we have take it here. We got the realization total as 83,300, which is nothing but your balance sheet total itself. Balance sheet asset total of a company. So the first journal entry will be realization account data to all assets account. Then the second one, because we transferred all assets, now it is time we transfer to creditors. Because assets are credited, now liabilities must be debited. Hence, we have taken only two liabilities into the account, creditors and bills payable. So same amount we will take, we transfer it to realization account. So liabilities account data to realization account. So first one is for assets transfer, second one is for liability transfer. Now after that, there are few liabilities which we have not taken at the time of purchase consideration. That is, capital we have not taken, general reserve we have not taken, profit and loss account we have not taken. Now that belongs to the equity share capital of the A limited. So we transfer equity share capital, general reserve, profit and loss account to the shareholders of that particular company. Then after that, purchase consideration of A limited is 80,000. So for this purchase consideration, we need to enter one journal entry, that is C limited account data to realization account. Who is giving purchase consideration? This purchasing company will give the purchase consideration. So here C limited is purchasing, hence C limited account data to realization account. So that is 80,000. Now, after that, how this 80,000 is payable in terms of shares? 80,000 is not paid in cash. They are paying in terms of shares. Hence, shares in C limited account data to C limited account, 80,000, we will take it here. Now, once the shares are received, after receiving the shares will be given to the shareholders. So hence, equity shareholders account data to shares in the C limited account, same 80,000, we will take it into the account. Now, profit on realization, we did not get any profit on realization because here we have 83,300 minus 3,300, which is liabilities. Purchase consideration is 80,000. Same value, 80,000, we have distributed it to the shareholders. Hence, there is nothing is left over as a realization or profit on the realization. So, your profit is nil in case of the A Limited. Now, the same way we enter the journal entries for the B Limited also. That is B Limited Transferor Company. Same, realization account data to all assets. When you are entering journal entries in the books of A Limited, you take the amounts of A Limited. When you are entering journal entries in the books of B Limited, you take the amounts of B Limited. So B Limited assets value you have taken. So realization account data to all assets. Same way liabilities to realization. Whereas in B Limited, we don't have bills payable. We have only creditors. So we have taken only creditors. So assets to realization account. Then the leftover liabilities, equity share capital, general reserve, profit and loss account will be transferred to equity shareholders. Then C Limited to realization is the purchase consideration for B Limited, 50,000. Then C Limited is issuing this 50,000 in the form of shares. So shares in C Limited to C Limited is 50,000. Then finally, once the C Limited has given the shares of 50,000, the same 50,000 shares will be issued by B Limited to its shareholders is 50,000. Even in B Limited also, there is no profit on realization. The profit on realization is nil because the purchase consideration is 50,000 and the amount received from the C Limited is also 50,000. Hence 50 minus 50, we get the nil balance. So there is no profit, there is no loss in terms of realization in case of the merger. So this is how we entered the journal entries in the books of transferor. Now we will see journal entries in the books of transferee. Now journal entries in the books of transferee. Now this is the first journal entry we enter in the books of transferee, that all assets to liabilities. We have taken goodwill. When you are taking journal entries in the books of C Limited is formed by combining the assets and liabilities of A and B Limited. Hence, when you are taking the amounts in the C Limited company, you need to add both the amounts, A Limited amount and B Limited amount. Then the total amount you have to take it in the journal entries. So hence goodwill, freehold premises, plant and machinery, stock, debtors and all other assets, you have to take the combined added value. Then two creditors, two bills payable, two purchase consideration. 50 plus 80, it comes to 1,30,000. Hence, this is how you have to enter the journal entry in the books of transferee company. Now, the second journal entry is liquidator of A and liquidator of B Limited. Why we are using the term liquidator here? Because when as the C company formed, there is no A company, there is no B company. A and B closed, wind up their operations. Hence, we call it as liquidator or liquidated. They liquidated, they closed their business. Hence, we have to mention the term liquidator. So, liquidator of A Limited, 80,000 is purchase consideration. Liquidator of B Limited, 50 is for purchase consideration. Total, they are paying in terms of equity share capital, that is 1,30,000. And the last journal entry after the purchase consideration is received, that will be transferred to both the companies. Hence, the business purchase account data to liquidator of A account to liquidator of B account. These are the three journal entries. One is for purchase consideration, second is for assets and liabilities transfer, and the third one is for transfer of purchase consideration to the liquidator of both the companies. This is how we enter the journal entries in the books of C company, that is transferee company. Hope it is clear with regarding to the journal entries in the books of transferor as well as transferee. If you can find the difference, in the books of transferor only, we will take the realization account, but in the books of transferee, there is no realization account. So that is the one difference which you can see between these two journal entries. Then finally, when we see the balance sheet, now whose balance sheet we are preparing? We are not preparing balance sheet of A, balance sheet of B, because A and B are not there in the market because they sold their business to C. Hence, we are preparing balance sheet of C. So this balance sheet belongs to C company. Whatever A is having, whatever B is having, total A plus B amounts, if you take, that will become the C amounts. So for C company, Share capital of A plus share capital of B. Reserves also, current liabilities, bills payable, creditors. For both the companies, you have to add and take the total. Same way, assets and fixed assets and current assets also. Add company A, company B. Or if you can see the journal entry here, the same figures we have taken here. So it will be 1,35,300, 1,35,300. And there is a small working notes with regarding to the general reserve and P&L account. Now, purchase consideration is 1,30,000 and share capital is for both the companies. For A, it is 75, for B, it is 45,500. It comes to 1,20,500. So, purchase consideration and the capital amount. Excess of written off profits is, that is difference between these two, 1,30,000 minus 1,20,500, it comes to 9,500. We have reserve, that is 3,200 for A and 2,500 for B, which comes to 5,700. Profit and loss account, that is for A 1,800, B 2,000 is 3,800. Now from 9,500, if you deduct same 9,500, it will be nil. That is, there is no reserves, there is no profit and loss account, there is no differences which we can see from the general reserve or the profit and loss account of the previous years of company A and company B. Hence, it is nil. We are not showing it in the balance sheet. So here, if you can see reserves and surplus, there is no amount shown because of this working notes. So this is how we enter the journal entries in the books of both the parties, as well as transfer party, transferee party. In this problem, we have two transferors. So hence, we have entered the journal entries in the books of two transferor parties and transferee also. This is how we prepare the journal entries as well as balance sheet with regarding to amalgamation in the nature of purchase. Let me share another screen. Now, journal entries in the books of transferor company. As I mentioned you, realization is the account which we will create in the books of transferor. In transferee, there is no realization. So the first journal entry we will enter in the books of transferor is realization to various assets. If you have 5 assets, you have to take 5 assets individually. Then second one, in the first one, we have transferred real assets and we have taken assets as credit amounts. Now here liabilities, you have to take it as a debit amounts. That is various liabilities account data to realization account. This is the second journal entry. And third one is for purchase consideration, transferee company account data to realization account. And fourth one for receiving the purchase consideration. How we are receiving purchase consideration? In what way? Are we receiving in the form of cash or bank, or are we receiving in the form of shares? So whichever way you receive, the same way you have to express in the journal entry. And next is assets sold by the transfer company, not taken over by the transferee company. There are few assets which may not be taken by the transferee company, that is the purchasing company. So such assets you have to enter here as bank account data, realization account data if you got any loss, to asset or to realization if you got any profit on sale of asset. Then for liquidation expenses, like when you start a company requires some sort of documentation or some sort of legal expenses which the organization has to go through with. Such expenses we call it as preliminary expenses. Same way, at the time of closing the business also, the company has to bear some of the expenses. Such expenses we call it as liquidation expenses, or we also call it as realization expenses. So when you have realization expenses or liquidation expenses given in the problem, you have to enter the journal entry as realization account data to bank account. Then for liabilities not taken over by the transferee, various liabilities account data, realization account to bank account, or to shares in transferee company to real account. This is with regarding to the liabilities which is not taken over by the transferee company. This is required when such type of transaction or such type of element is mentioned to you in the question. Mostly such transaction will not be asked to you in the question because they mostly transferee company will prefer to take all liabilities and all assets. So hence it is a rare transaction which you will come across in the problem. Then for transferring the share capital, if preference share capital is transferred, then you have to take preferential share capital account data, realization account data to preferential shareholders account to realization account. And if you got any profit in the realization to equity shareholders you have to take. And if you get loss, the reverse of the above entry, that is equity shareholders to a realization account. These are the most common journal entries which we will enter in the books of the transferor. Now, this is with regarding to the transferee journal entries. For in the books of transferee, that is purchasing company, we will enter three main journal entries. The first one is for the business purchase account data to liquidator of transferor company. Then for recording the assets and liabilities taken over, all assets account data to liabilities to reserves if any to business purchase. In this second journal entry, you will get a difference. If your debit amount is more, you will get a difference. Then you have to take it as a credit as capital reserve. If your credit values are more, you will get the difference and you have to take it as debit side as goodwill account data. And the last one you have to enter is liquidator of transferor company account data to bank if you are paying in cash, to capital if you are paying in shares, premium if you are paying any additional face value, more than the face value. Suppose if the face value is 10, but you are issuing at 12 rupees, the 2 rupees extra is nothing but your premium. So if any premium is paid, you have to explain, you have to show the premium separately in the books of the accounts. So these are the most common journal entries which we can see in the transferee books of accounts. Now, if you see the difference between amalgamation in the nature of merger or amalgamation in the nature of purchase, in the nature of merger, in case of transferee company, must acquire whole business of the transferor company, which includes all assets and liabilities. In case of merger, purchasing company will take entire assets and liabilities from the transferee company, selling company. Whereas in case of purchase, the purchasing company will take only assets and liabilities. It will not take reserves and surplus of selling company. Then in case of merger, shareholders having 90% of the face value of equity shares of transferor company become the equity shareholder of the transferor company. If any shareholders having 90% of the face value of equity shares in the selling company, by default, automatically they will become a part in the purchasing company. Whereas such type of clause is not applicable in case of the nature of purchase. Then the claim of equity shareholders of the transferor company must be discharged by transferee company issuing equity shares only except in case of fractional shares. That means if in case of merger, if the equity shareholders of transferor company, they have to pay the purchase consideration in the form of equity shares only. They cannot give the shares out of the fractional shares or out of the reserved shares. They have to give the shares out of free issued shares only. In case of purchase, the claim of equity shareholders of transferor company may be discharged by issuing the equity shares or cash. In case of purchase, the purchasing company can pay the purchase consideration either in the form of cash or in the form of equity shares. Whereas in case of merger, mostly equity shares is the only option left over with the merger. Then in case of merger, all assets and liabilities of the transferor company are taken over by the transferee at the book values. So at the book values only, the assets and liabilities will be taken over by the purchasing company in case of merger. Whereas in case of purchase, the market value will be considered, not the book value. Now, in case of merger, any difference that comes between the net worth and the purchase consideration is taken as either general reserve or profit and loss account. Whereas in case of purchase, the difference can be taken as either goodwill or capital reserve. Any of the case may be possible. As I told you, if your debit is more, you will get capital reserve, or if your credit is more, you will get the goodwill. So this is how the problem which go on in case of amalgamation in the nature of merger, purchase consideration in the form of net assets method. I hope the concept is clear to you all. I conclude my today's session with this concept. In the next session, we will continue with furthermore topics. Have a good day. Thank you.